10 years ago, the Singapore dollar to Malaysian ringgit was just at a 2.2 exchange rate. But now, it has hit a record high of 3.47. While this is good news for Singaporeans who like to go to Malaysia to eat good food and pump cheap petrol, this is bad news for many Malaysians who are seeing their day-to-day spending becoming more and more expensive. In this video, we will be looking at why the ringgit has been depreciating against the Sing dollar. Is it just bad politics or is it something else? What is the future for the ringgit? And more importantly, what can Malaysians do to protect yourselves against this? Also, do join my Telegram group to discuss or ask any questions that you may have. With that being said, let's jump right in. The first reason as to why all this is happening is due to the differences between how central banks in Malaysia and Singapore manage their currencies. Let's talk about Singapore first. Singapore is a small and open economy which relies heavily on trades with other countries. For example, Singapore imports most of its basic needs, such as food, energy, and raw material. Out of every dollar spent in Singapore, around 40 cents goes to import. At the same time, Singapore also heavily exports to other countries. The exchange rates have a greater influence over domestic inflation as compared to interest rates. Because of that, Singapore has chosen to control inflation by managing its exchange rate instead, as it's more effective as compared to raising interest rates as what many other countries have done. On the other hand, Malaysia chooses to manage its interest rates to control inflation. So what happened was that while the US has been raising rates fast and furious to 5.5% now, Malaysia's interest rate has been going up a lot slower and is now sitting at just 3%. This makes the USD a lot more attractive as compared to Malaysian ringgit, as investors get to earn more interest in USD than in Malaysian ringgit. This explains why the USD has also been appreciating against the Malaysian ringgit. Meanwhile, the Singapore Central Bank, or MAS, has decided to tighten the monetary policy by letting the Singapore dollar nominal effective exchange rate go up. And that is why the Sing dollar will appreciate a lot faster as compared to the Malaysian ringgit. The next reason is that Malaysia has a high exposure to the China market. In 2022, the value of trade between Malaysia and China was about 17% of Malaysia's total global trade, or about 2.8 trillion ringgit. That's T with 12 zeros. So remember, during the pandemic when China had the whole lockdown, which caused its economy to slow down, since then, the recovery has been slow. Add in the property crisis, and as a result, all that has reduced the demand of imports from Malaysia, which is also why Malaysia saw a 14% drop in imports from 2022 to 2023. Quick pause, have you heard? Weibo has a newly upgraded sign-up promotion. From now till October 31st, if you sign up using my link down below, fund any amount and keep the money there for 30 days, you get to win 2 free shares worth up to 2,000 US dollars in total, all without doing any trades, and that is literally free money. Also, whether you are an active trader or a passive investor, you will need a proper platform to support all your investment needs. With Weibo, you will have access to extended trading hours, 24/7 customer service, ability to access the global market, and check your stock portfolio whether you are on the go via the mobile app or at home with the desktop app. And that is super convenient, yeah? So if you are interested in trying out Weibo, do sign up to them using my link down below. With that being said, let's get back to the video. Next, Malaysia is a country that is rich in natural resources such as rubber, timber, palm oil, petroleum, and so on. That's why its economy is highly dependent on agriculture, which makes up almost 9% of its GDP in 2022. However, this also means that Malaysia's economy is also dependent on global commodity prices. So if ever there's a drop in commodity prices, Malaysia would earn less as a nation. On the other hand, Singapore basically has no natural resources other than, hardworking men and women. That's why they had to focus more on the service industries, such as manufacturing, finance, and technology. In 2021, Singapore has attracted 2.5 trillion Singapore dollars in FDI, while Malaysia only attracted 880 billion Malaysian ringgit, which is about 10 times less than Singapore. This could be due to various factors such as political stability, lower corporate tax rate, less complicated business regulations, all of which makes it easier to start a business in Singapore as compared to Malaysia. At the same time, there's a higher investors' confidence in Singapore economy. With a strong current account surplus and solid foreign exchange reserves, Singapore was given a AAA credit rating by multiple credit rating agencies and was assessed to have a stable outlook. On the other hand, Malaysia's credit rating was recently downgraded to BBB+ by Fitch. This is due to the impact of the pandemic on Malaysia's fiscal and government debt position. As of 2022, the government debt in Malaysia amounted to $1 trillion, or a ratio of 60.4% debt to GDP. This would take Malaysia 30 years to fully settle the debt, while Singapore's debt to GDP ratio is at a whopping 171%. The difference is that Singapore has a zero net debt. So as you can see, due to all these reasons, the Singapore dollar is a more attractive currency as compared to the Malaysian ringgit, which explains why the ringgit has been on a downtrend against the Sing dollar. Now obviously, the Bank Negara of Malaysia has been doing what it can do to support the ringgit. But there's also a limit to what it can do, as its foreign currency reserves have dipped below 100 billion USD. In contrast, Singapore's foreign currency reserves is about 3 times larger. Hosei bo. So what does this mean for Malaysia? And is there even any more hope for the ringgit? From a business perspective, a weakening ringgit can be good for Malaysia as it becomes cheaper for foreign companies to do business in the country. However, this is bad for Malaysians, as this means higher cost of living due to imports becoming more and more expensive, and overseas travel will end up becoming more costly. So if you are Malaysian or are currently holding to a large amount of ringgit, what can you do? GG lor. There are a few things that you can do to counter the depreciating ringgit, other than, come to Singapore to work. First, you can convert your ringgit to other currencies such as SGD or USD and keep your savings there. This will help you reduce your ringgit depreciating while giving you the opportunity to earn from favorable exchange rates from the stronger currencies. Second, instead of letting your money sit idle in the bank like a lazy bum, it's also important to invest the money, not just to fight against the ringgit depreciating, but also to fight against the inflation. For short-term savings, you could invest in the Malaysian fixed deposits, which would easily give you around 3% interest. However, this alone would be barely enough, given that the 2% inflation will eat up all the interest. That's why it's important to also invest the money that you do not need in the short term. For example, something like the S&P 500 would give you an annualized return of 10%, or something like the All-World ETF VWRA, which gave 8% annualized return. Historically speaking, of course. The trick is to just keep buying good companies no matter what. Market up, you buy. Market down, you cry a bit, then you buy more. And over the long term, you will do well. Anyway, that's all for this video. Hopefully, you found it useful. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.